Welcome to Chapter 2. Okay, this is the first of 8 chapters. So chapters 2 to 9. Topic: how should a Canadian company report in its financial statements an investment in the shares of another company? So it depends on why the investing company is holding the shares. So there's non-strategic or passive reasons which will earn a return or profit without playing an active role in the strategic decisions of the investee. So you just invest in shares, you've got some extra cash sitting around, you do it for a year, and then you use the money for something else. That's it. You don't care what's happening with the other company, other than hopefully they are appreciating. So those are non-strategic. The other 3 are strategic. And there's different levels. So you did talk about them at the beginning of Accounting 315 when you talked about the conceptual framework and how much control you could have, and it leads to different accounting practices. So there's strategic reasons where the investor has significant influence on the investee. So it's defined as the power to participate in the financial operating policy, but you don't have control or joint control. Okay? So you own enough that you can influence their decisions, the board's decisions, but you don't own enough that you control them. There's also strategic reasons where the investor does control the investee, and control exists when an investor is exposed to or has the rights to variable returns from its involvement with the investee, and the ability to affect those returns through power over the investee. So you definitely have decision-making power. And we'll talk about those conditions in a little while. Then there are strategic reasons where there is joint control, which is a whole nother thing, between 2 companies. Now, we won't be doing this till chapter 9, but joint control exists as if the owners or the venturers have made a contractual agreement that establishes joint control over the venture, and no single venturer can control the venture. So, for example, let's say you, with all your marketing and business ability, got together with a friend and created a company, and your friend was an engineer, and so you're creating new products. If you made a control where it's a joint control, the contract would state who is responsible for things, who can make decisions on their own, and so on. For example, maybe in technical processes or what patents you put forward, the engineer, your engineer friend, might have more control over that. Or for marketing decisions, you might have more control over that. Your contract would state it, and it says what you can do. So maybe you wanted to agree that neither of you can make a decision on a product, whether we keep it or not, by themselves. It has to be joint. That's the kind of thing that's spelt out in that. So, as we go through the course, we're going to apply the above definitions to problem material. And there's actually qualitative decisions involved in all of them. We'll talk about them in a little while, but it's still possible to use the percentage of shares owned as an indication here. And we'll break down those percentages in a second. Now, first of all, I want to raise something that's going to come up again and again, OCI. So IFRS uses OCI. And throughout this course, as we did a few times in the other courses, we've talked about how IFRS uses I, and why does it matter if a gain or loss is classified in net income versus OCI. So I just want to give you a little review on that. So first, over on this side, because I want to leave space here for something else, we have income statement or statement of profit and loss, or statement of financial performance, lots of names for it. So what do we say? Well, the sales, the revenue. Then we take all away our operating expenses. And of course, you know, there's the multi-step, there's a single step, that kind of thing. Then we take away gains and losses from operations. And then we get to take off income tax expense. We next do it. And this is going way back to 315. That gives you net income before discontinued operations, or income of continued operations, or income from continuing operations. Remember, when you are doing these, you have to use the best name that's there to pick from. Okay. For example, you wouldn't just use net income because you haven't put discontinued ops yet. So then we get plus or minus gains and losses from discontinued ops. And that finally gives us net income. But then for IFRS, we have that little OCI category, other comprehensive income, and you add plus OCI, gains and losses, if you remember that. Finally, at the very bottom, we get comprehensive income. So we will, in this chapter, as we did in chapter 19, classify investments either being before, up here, just in regular gains and losses from ops, or gains and losses in OCI. And they are very strict on that. So, I want you to think about why. Who cares? It's all in the comprehensive income statement. Well, think about what the formula for EPS is. Earnings per share. That wasn't too long ago. That was just in 316, right? So you take your net income, and what do you take off? Preferred share dividends, and there's little rules about whether it's declared or not, cumulative or not, that kind of stuff. And on the bottom is weighted average common shares, or WACs. Oh my God, I can't get my M's and W's straight. Okay, so it's weighted average common shares on the. So, notice, first of all, this is a critical ratio. If you look at any announcements about stocks on a market, when they're discussing their earnings or anticipated earnings, they will mention earnings per share and what they expect it to be or what it is. Critical. Decisions are made about buying and selling based on EPS and what you expect it to be. So, what does it start with? Does it start with OCI? No, it starts with net income. So it kind of ends here. So, let's say you had a bad year with some of your stocks. And the choice between putting it in OCI or up here. Well, it's going to be a loss. Where would you want to put it, given the fact that earnings per share is going to be looked at? Well, you would like to hide your loss, right? So you'd want to put it so that this wouldn't look so bad. And then if you had a good year, what would you like to do? By the way, you can't do this, but what would you like to do? Oh, you want to put it up here with net income, that it can go in EPS and make you look better. So as do you think it's good to flip-flop back and forth? No. So that's why they make specific rules about OCI investments, and we'll talk about it on the next couple pages. But the key thing is EPS is not influenced by gains and losses in OCI. So therefore, to stop executives from painting only the best picture of earnings per share, choice of using OCI method for investments is irrevocable. You can only choose it to put it in there once and can't take it back out. And vice versa. That's people from flip-flopping back and forth to make earnings per share look better. Okay? So I just wanted to explain that to you because as we go talking, remember it's got to stay, it's never going to go through OCI or vice versa. You might wonder why. This is why. It's that critical. EPS is that important. Okay, so on page 2, as I said, there's a lot of qualitative factors that tell us whether we have control or significant influence and things like that. Now what I want to do is just summarize it in percents and kind of give you a table you can look back to refer to. So, FV is fair value. We're going to look at the type of investment, the percentage owned in general, IFRS accounting method that's possible to use, and where do the unrealized gains and losses go when the investments increase or decrease. So, non-strategic is IFRS, and that is going to be in chapter 2. The percent small, so it's less than 20%. And this percentage owned is common shares. Now the fair value through profit and loss, last year in your text you saw it, fair value, oh my goodness, what did you do? Oh, TPL. And last year it was fair value net income. So it doesn't matter whether you TPL or net income. There's fair value through OCI. So remember you learned this already. Oh my goodness. Fair value through OCI. Okay. So when it's non-strategic, so roughly you own less than 20%, you can either use, and this is IFRS, fair value through net income or fair value through OCI. Now, each year you're going to write those investments, if you remember, to fair value. So you're going to have unrealized gains or losses. These ones are going to go in net income. These ones are going to go in OCI. Now, chapter 2 is significant influence. It's also chapter 2, but also each chapter, as will become apparent when we go through them. So this is where you own 20 to let's put less than or under. Yeah, let's put less than 50%. And for that, you're going to use the equity method. For the equity method, we don't write to fair value. That says value. I don't know what is wrong with my writing today. And there are no unrealized gains because it's not at fair value. Now, control is chapters 3 to 9. And if you own control of a company, how much do you have to own? Greater than 50%. Or equal. I'm going to put the equal with this one, and I'll talk about that in a sec. So it is consolidation, which we are going to spend the next few chapters learning. and there are no unrealized gains or losses. It's not at fair value. Finally, joint control is Chapter 9. It's called the venture. You use the method, just like up here, and is not fair value. There's nothing there. Now, one little caveat. Whenever you're a non-fair value method, always check for impairment. Okay? So this one we check for impairment. This one we check for impairment. This one we check for impairment. Do we need to know those? No, because they're automatically put to fair value. So you'll be marking it that way right away. Okay, so that's basically a summary of what we're going to cover in the next few weeks. And I will start on the next section with the next video.